Question 1. In a variable annuity, which of the following factors is not directly related to the amount of investment risk the annuitant faces? A. The performance of the underlying investment subaccounts. B. The level of the guaranteed minimum income benefit (GMIB). C. The frequency of annuity withdrawals. D. Market volatility affecting subaccount returns. Answer: B. The level of the guaranteed minimum income benefit (GMIB). Explanation: the guaranteed minimum income benefit (GMIB) in a variable annuity provides a safety net for annuitants by ensuring a minimum payout regardless of the performance of the investment subaccounts. This feature reduces investment risk by offering a baseline of security for income regardless of market performance. The other options, however, are directly tied to investment risk in variable annuities. For instance, subaccount performance directly impacts the account's value, while market volatility and withdrawal frequency influence both risk exposure and potential depletion of the account. Regulatory guidelines require disclosure of these risks to help ensure the annuitant understands the variable nature of the annuity's performance, as outlined in the prospectus and according to suitability standards for variable annuities. Question 2, scenario-based. Sarah, a 65-year-old retiree, has a variable annuity and is considering taking a large withdrawal to help fund an unexpected medical expense. However, she is aware that early withdrawals might incur surrender charges. Her annuity is currently in the accumulation phase and she wants to minimize fees and penalties. What should Sarah do to best manage her finances given these circumstances? A. Consult with her financial advisor to determine if her annuity's free look period allows penalty-free withdrawals. B. Confirm if her variable annuity includes any liquidity riders that allow penalty-free access in case of emergencies. C. Withdraw a lump sum, as surrender charges typically decrease significantly in the first few years. D. Take a systematic withdrawal, as it avoids all surrender charges regardless of her annuity type. Answer: B. Confirm if her variable annuity includes any liquidity riders that allow penalty-free access in case of emergencies. Explanation: Sarah's situation highlights a critical aspect of variable annuities, access to funds and the possibility of penalties. Many annuities have liquidity or hardship riders, which permit penalty-free withdrawals under specific circumstances such as severe illness or medical expenses. By consulting her advisor about these options, Sarah can potentially avoid surrender charges associated with a one-time withdrawal. Systematic withdrawals (option D) do not necessarily eliminate surrender charges unless specified by the contract, and the free look period (option A) generally applies at the very beginning of the contract rather than in the accumulation phase. Surrender charges also typically decrease over time, but assuming they would significantly diminish early on (option C) is misleading. Regulations ensure that insurers provide clear terms for riders and charges in the annuity contract, aiding consumers like Sarah in making informed financial decisions. Question 3. Under Alaska's annuity regulations, which of the following is essential for determining the suitability of an annuity for a client? A. Client's health status and recent medical history. B. Client's annual income, financial status, and investment objectives. C. Recent stock market trends that could affect the annuity performance. D. Insurance agent's personal assessment of the annuity product's potential returns. Answer: B. Client's annual income, financial status, and investment objectives. Explanation: Alaska regulations emphasize that the suitability of an annuity must align with the client's financial profile, investment goals, and overall financial status to ensure the annuity meets the client's needs and risk tolerance. Key factors in assessing suitability include the client's income level, financial goals, e.g., retirement security, and experience with financial products. Health status (option A) and recent market trends (option C) may impact the client's personal considerations but are not primary suitability factors under Alaska law. Additionally, the agent's assessment (option D) should be based on objective criteria rather than personal opinion, as misrepresentation can lead to regulatory violations. By adhering to suitability guidelines, agents help ensure clients are advised in their best interests, as mandated by the Alaska Division of Insurance. Question 4. Which of the following statements accurately describes the tax treatment of earnings within a deferred annuity contract? A. Earnings are taxed annually based on the contract's interest rate. B. Earnings grow tax-free similar to a Roth IRA. C. Earnings grow tax-deferred and are only taxed upon withdrawal. D. Earnings are taxed when credited regardless of withdrawal status. Answer: C. Earnings grow tax-deferred and are only taxed upon withdrawal. Explanation: In a deferred annuity, earnings accumulate on a tax-deferred basis, meaning that taxes are postponed until the funds are withdrawn. This feature allows the annuity holder to benefit from compounding returns without annual tax deductions. However, withdrawals are subject to ordinary income tax, and early withdrawals before age 591 may incur an additional 10% IRS penalty. Unlike Roth IRAs, which offer tax-free growth for qualified withdrawals, deferred annuities do not provide tax-free growth. The concept of tax deferral is a key advantage for annuities, especially for long-term retirement planning, and is regulated by IRS guidelines and tax law. Question 5. Which of the following options best describes a key feature of an indexed annuity that differentiates it from a variable annuity? A. Indexed annuities have a fixed interest rate that cannot be adjusted. B. Indexed annuities offer a guaranteed minimum return along with potential interest based on an external index. C. Indexed annuities allow direct investment in stock market subaccounts. D. Indexed annuities are limited to a fixed, unchanging interest rate. Answer: B. Indexed annuities offer a guaranteed minimum return along with potential interest based on an external index. Explanation: Indexed annuities combine elements of both fixed and variable annuities by providing a guaranteed minimum return with the opportunity for additional interest based on an external index, e.g., the S&P 500. This means that while the annuity holder benefits from potential index-related growth, they are protected from market losses by the guarantee of a minimum return. Unlike variable annuities, which invest directly in market subaccounts, indexed annuities do not involve direct market exposure, and their returns are subject to caps, participation rates, and other limiting factors. This hybrid nature makes indexed annuities suitable for investors seeking some growth potential with low risk, adhering to suitability standards. Question 6. Scenario-based. John, a 55-year-old professional, is considering purchasing an immediate annuity to supplement his income as he transitions into semi-retirement. John wants to ensure a steady income but is concerned about potentially outliving his assets. What payout option should John consider to best address his concerns? A. Lump sum withdrawal, allowing for maximum flexibility. B. Life income option, providing payments for as long as he lives. C. Fixed period option, ensuring payments for a set number of years. D. Joint life option, covering both him and his spouse. Answer: B. Life income option, providing payments for as long as he lives. Explanation: The life income option offers John guaranteed payments for the rest of his life, alleviating his concern about outliving his assets, known as longevity risk. This option addresses his need for predictable lifelong income. A lump sum withdrawal option A would not provide a steady income stream, and a fixed period option, option C, would only guarantee payments for a specific time, after which payments would cease. The joint life option, option D, could cover both John and a spouse, but may reduce the individual payment amount compared to a single life income option. Life income options are particularly beneficial for retirees seeking income stability and are governed by annuity suitability and disclosure regulations. Question 7. Which of the following is a characteristic feature of a guaranteed lifetime withdrawal benny-eligible rider in an annuity? A. It provides a fixed one-time payment to the annuitant. B. It guarantees a minimum income stream for a limited term. C. It allows for withdrawals while guaranteeing income for the annuitant's life, even if the account balance is depleted. D. It eliminates all surrender charges for early withdrawals. Answer: C. It allows for withdrawals while guaranteeing income for the annuitant's life, even if the account balance is depleted. Explanation: The GLWB rider allows annuitants to make periodic withdrawals while ensuring that income continues for life, even if the contract's balance reaches zero. This feature mitigates longevity risk by guaranteeing a lifetime income stream regardless of the account balance. Unlike a fixed one-time payment, option A, or a limited term guarantee, option B, the GLWB provides lifelong coverage. It does not typically remove surrender charges, option D, which may still apply to early withdrawals beyond permitted amounts. This rider is regulated to meet suitability standards and must be disclosed fully to annuitants to clarify potential fees and benefits. Question 8. In Alaska, which of the following actions must a licensed insurance agent take when selling an annuity to ensure compliance with anti-money laundering regulations? A. Perform an exhaustive background check on the client's financial history. B. Provide the client with a financial literacy test. C. Verify the client's identity and monitor for suspicious transactions. D. Disclose the commission rate to the client. Answer: C. Verify the client's identity and monitor for suspicious transactions. Explanation: AML regulations require insurance agents to implement procedures that prevent annuities from being used for money laundering. This includes verifying the identity of clients using identification documents, monitoring transactions for suspicious activity, and reporting such activity when required. While financial background checks option A are not mandated, ongoing monitoring option C aligns with AML requirements. Disclosing commissions option D relates to transparency but is not part of AML compliance, and financial literacy tests option B are not required under AML regulations. This helps maintain financial integrity and protects against unlawful use of insurance products. Question 9. Which of the following best describes the purpose of the free look period in an annuity contract? A. To allow the insurer to assess the risk level of the annuitant. B. To enable the annuitant to cancel the contract within a certain period and receive a full refund. C. To permit changes to the annuity's payout options without penalties. D. To allow the agent to earn a higher commission if the annuitant keeps the contract. Answer: B. To enable the annuitant to cancel the contract within a certain period and receive a full refund. Explanation: the free look period gives annuity buyers a specified number of days, determined by state regulations, to review the contract terms and cancel the annuity if they choose, receiving a full refund of any premiums paid. This period is designed to protect consumers, allowing them to back out if they feel the product does not meet their needs. Options A and D misrepresent the purpose of this period, as it is intended solely for consumer protection. Similarly, changing payout options. Option C is not typically associated with the free look period. Alaska mandates disclosure of this provision in the annuity contract to ensure buyers are aware of their rights. Question 10. Under Alaska law, which of the following practices would violate ethical standards in annuity sales? A. Providing clear disclosures about all fees and penalties in the annuity contract. B. Making exaggerated claims about the potential returns of a variable annuity. C. Conducting a thorough suitability analysis before recommending an annuity. D. Advising a client to consider liquidity needs when selecting an annuity. Answer: B. Making exaggerated claims about the potential returns of a variable annuity. Explanation: exaggerating potential returns violates ethical standards because it can mislead clients about the performance expectations of a variable annuity, which can fluctuate based on market conditions. Ethical and suitability standards require agents to provide clear, accurate, and balanced information to clients, avoiding any misrepresentation of potential benefits. Providing full disclosures option A. Conducting a suitability analysis option C. And considering liquidity needs option D are required practices to ensure clients make well-informed decisions. Alaska law mandates adherence to ethical sales practices with penalties for agents who engage in deceptive or misleading behavior. Question 11. In Alaska, an insurance agent who recommends an annuity to a client must ensure the annuity aligns with the client's financial objectives and risk tolerance. What is this process called? A. Client review. B. Suitability analysis. C. Policy alignment. D. Needs assessment. Answer: B. Suitability analysis. Explanation: a suitability analysis requires agents to evaluate whether an annuity is appropriate for a client's financial goals, risk tolerance, and overall situation. This is an essential regulatory step intended to protect clients from purchasing unsuitable products and is required by both state and federal regulations. Unlike policy alignment or needs assessment, suitability analysis is a defined regulatory process focused on ensuring the client's best interests. Question 12. Which of the following best describes the tax treatment of a traditional fixed annuity in Alaska? A. Interest is taxed annually at a flat rate. B. All earnings are tax deferred until they are withdrawn. C. Contributions are taxed immediately, but growth is tax-free. D. There are no taxes on the earnings or withdrawals. Answer: B. All earnings are tax deferred until they are withdrawn. Explanation: in a traditional fixed annuity, earnings grow on a tax-deferred basis, meaning taxes are not applied until withdrawals are made. This tax deferral allows for compounding growth without an annual tax burden. Taxable events occur upon withdrawal when income tax is applied based on the annuitant's tax bracket. Question 13. Scenario-based. Sarah, a 63-year-old retiree in Alaska, wants a steady stream of income but is concerned about inflation eroding her purchasing power over time. Which annuity option might best address her concern? A. Fixed annuity with a level payout. B. Variable annuity with payments tied to investment performance. C. Immediate annuity with a fixed payout. D. Deferred annuity with a single lump sum payout. Answer B. Variable annuity with payments tied to investment performance. Explanation: a variable annuity allows payments to fluctuate based on investment performance, providing Sarah with the potential for income that may keep pace with inflation. Fixed payouts, such as options A and C, do not adjust for inflation, which could diminish purchasing power over time. A single lump sum option D does not meet her need for a steady income stream. Question 14. What is a 1035 exchange in relation to annuities? A. A feature that allows penalty-free withdrawals in case of emergency. B. A tax-free transfer from one annuity to another. C. A rebate on surrender charges. D. An option to borrow against the annuity's value. Answer B. A tax-free transfer from one annuity to another. Explanation: a 1035 exchange allows annuity owners to transfer funds from one annuity contract to another without incurring taxes on the gains at the time of the exchange. This option is especially useful for those seeking to upgrade or change annuity features, and it is named after the IRS code section that allows it. Question 15. In Alaska, which of the following statements is true regarding annuity withdrawals before the age of 591? A. Withdrawals are completely tax-free. B. Withdrawals are subject to ordinary income tax but not penalties. C. Withdrawals are subject to both ordinary income tax and a 10% penalty. D. Withdrawals are penalty-free but may incur surrender charges. Answer C. Withdrawals are subject to both ordinary income tax and a 10% penalty. Explanation: the IRS imposes a 10% penalty on annuity withdrawals made before age 591 in addition to ordinary income tax. This penalty is designed to discourage early withdrawals, as annuities are intended for long-term income purposes. However, certain exceptions apply, e.g. disability, death of the annuity owner, where the penalty may be waived. Question 16. Which of the following is typically considered a disadvantage of variable annuities? A. Fixed interest rates regardless of market conditions. B. Lack of tax-deferred growth. C. Higher fees and expenses compared to other types of annuities. D. No investment flexibility. Answer C. Higher fees and expenses compared to other types of annuities. Explanation: variable annuities often come with higher fees, including management and mortality fees, which can reduce overall returns. While they offer tax-deferred growth and investment flexibility, these additional fees are a common disadvantage compared to fixed annuities. Question 17. A surrender charge is most likely to be applied when A. An annuity owner makes a withdrawal within the first few years of the contract. B. An annuity reaches the payout phase. C. Interest is credited to the annuity account. D. No withdrawals are made during the contract term. Answer A. An annuity owner makes a withdrawal within the first few years of the contract. Explanation: surrender charges are penalties that apply if an annuity owner withdraws funds too soon, typically within a specified period after purchase, e.g. 510 years. This discourages early withdrawals and helps the insurer recover initial costs. Once the surrender period has passed, withdrawals can usually be made without penalty. Question 18. Which of the following is a characteristic of an equity-indexed annuity? A. Direct investment in the stock market. B. A fixed interest rate with no market-based adjustments. C. Returns that are tied to a market index with a guaranteed minimum. D. No fees or caps on returns. Answer C. Returns that are tied to a market index with a guaranteed minimum. Explanation: equity-indexed annuities provide returns based on the performance of a specified market index, with a guaranteed minimum interest rate to protect against market downturns. This blend of growth potential and principal protection distinguishes them from both fixed and variable annuities. Equity-indexed annuities typically have fees and caps that limit returns. Question 19. Under Alaska law, an insurance agent is required to provide which of the following disclosures to a client purchasing an annuity? A. Potential penalties and surrender charges. B. The insurer's investment strategy. C. A forecast of exact returns over the contract's life. D. Confidential client information to third parties. Answer A. Potential penalties and surrender charges. Explanation: agents must disclose key information to clients, including potential penalties, fees, and surrender charges associated with the annuity. This transparency is mandated to ensure clients understand the financial commitment and any possible limitations on early withdrawals. Agents are not required to disclose proprietary investment strategies, and disclosure of client information is strictly regulated by privacy laws. Question 20. Which of the following is a common use for a deferred annuity in retirement planning? A. Immediate income for daily expenses. B. A source of emergency funds. C. Long-term tax-deferred growth for future income. D. Short-term investment growth. Answer: C. Long-term tax-deferred growth for future income. Explanation: deferred annuities are designed for long-term growth, allowing individuals to accumulate funds on a tax-deferred basis until they reach retirement and need income. Unlike immediate annuities, which begin payments shortly after the contract is purchased, deferred annuities focus on asset accumulation and later provide an income stream to help supplement retirement. Question 21. In Alaska, which of the following is TRUE? About the free look period for annuities: A. It allows policyholders to cancel within 5 days without penalty. B. It applies only to variable annuities. C. It allows policyholders to cancel within a specified period, often 10 to 30 days, with a full refund. D. It requires policyholders to pay a cancellation fee if they cancel during the free look period. Answer: C. It allows policyholders to cancel within a specified period, often 10 to 30 days, with a full refund. Explanation: the free look period is a legally required time frame allowing annuity purchasers to review the contract and cancel for a full refund. This period typically ranges from 10 to 30 days, depending on the state and insurer. It applies to various types of annuities, not just variable ones, and does not involve a cancellation fee. Question 22. Which of the following features is typically associated with an immediate annuity? A. A mandatory waiting period before payments begin. B. Payments that start immediately after a lump sum premium is paid. C. Annual tax reporting regardless of payout status. D. Guaranteed growth tied to stock market performance. Answer: B. Payments that start immediately after lump sum premium is paid. Explanation: an immediate annuity begins payments soon after lump sum premium is paid, often within a month. This annuity type is intended to provide regular income quickly, usually for retirement. It does not have a waiting period or rely on stock market performance for growth, as it offers fixed or predetermined payments. Question 23. What is the primary purpose of an annuity as a guaranteed minimum withdrawal benefit? A. To protect against inflation. B. To ensure lifetime income even if the account balance is depleted. C. To provide a penalty-free early withdrawal option. D. To enhance tax benefits on distributions. Answer: B. To ensure lifetime income even if the account balance is depleted. Explanation: the guaranteed minimum withdrawal benefit will ensure that the annuity holder can continue receiving income even if the annuity's account balance runs out. It is designed to provide financial security for life, making it particularly valuable for retirement income planning. Question 24. Under Alaska regulations, a replacement transaction is triggered when: A. A policyholder renews an existing annuity contract. B. An existing annuity is surrendered, changed, or used to fund a new annuity. C. The annuitant passes away. D. The insurer changes the annuity's terms without policyholder consent. Answer: B. An existing annuity is surrendered, changed, or used to fund a new annuity. Explanation: a replacement transaction occurs when a policyholder replaces one annuity with another by surrendering, changing, or exchanging the existing policy. Regulators require agents to document these transactions to ensure that the replacement benefits the policyholder, considering factors like surrender charges and new costs. Question 25. Which of the following statements about surrender charges is CORE? A. Surrender charges apply only to fixed annuities. B. Surrender charges decrease over time in most annuities. C. Surrender charges are fixed and never change. D. Surrender charges increase the longer the annuity is held. Answer: B. Surrender charges decrease over time in most annuities. Explanation: surrender charges typically decline gradually during the surrender period. Many annuities have a surrender charge that applies within the first several years, but decreases over time, eventually reaching zero after the surrender period ends. Question 26. In Alaska, an annuity contract is required to include which of the following disclosures? A. The projected return for each year of the contract. B. Information about potential surrender charges and fees. C. Guaranteed annual increases of at least 5%. D. The agent's commission for selling the annuity. Answer: B. Information about potential surrender charges and fees. Explanation: annuity contracts must disclose surrender charges, fees, and other key details to ensure transparency for the policyholder. Projected returns and guaranteed growth rates are not typically included unless specified in a variable annuity or specific contract feature. Disclosure of agent commissions is generally not required. Question 27. What is a common feature of a qualified annuity? A. It allows tax-free contributions up to a certain limit. B. It permits tax-deferred growth but limits contributions based on IRS rules. C. It imposes no restrictions on contributions or withdrawals. D. It provides immediate tax benefits on all distributions. Answer: B. It permits tax-deferred growth but limits contributions based on IRS rules. Explanation: Qualified annuities are funded with pre-tax contributions and are subject to IRS contribution limits, typically because they are used in retirement accounts like IRAs or 401k plans. These annuities offer tax-deferred growth and taxes are applied upon distribution, typically at retirement. Question 28. What is the primary reason an investor might choose a deferred variable annuity? A. Guaranteed returns without any risk. B. Immediate income for current needs. C. Potential for high returns through investments with tax-deferred growth. D. Fixed returns with no connection to market performance. Answer: C. Potential for higher returns through investments with tax-deferred growth. Explanation: A deferred variable annuity allows for potential higher returns through market-based investments with tax-deferred growth. Unlike fixed annuities, variable annuities are tied to the performance of underlying investments, giving the holder the opportunity to benefit from market gains, though they also carry market risk. Question 29. If an Alaska resident wants an annuity that guarantees a set payment for life but also adjusts for inflation, they should consider: A. An equity-indexed annuity with a fixed payout. B. A fixed annuity with inflation protection. C. A variable annuity without any adjustments. D. A deferred annuity with tax-free growth. Answer: B. A fixed annuity with inflation protection. Explanation: A fixed annuity with inflation protection provides guaranteed payments that are adjusted based on inflation rates, ensuring purchasing power is maintained over time. Equity-indexed annuities or deferred annuities do not necessarily provide inflation adjustments to the payouts. Question 30. For tax purposes, annuity payments received by an individual after retirement are generally treated as: A. Tax-free income. B. Capital gains income. C. Ordinary income. D. Qualified dividend income. Answer: C. Ordinary income. Explanation: Distributions from annuities are typically taxed as ordinary income because they consist of pre-tax or tax-deferred contributions and earnings. This differs from capital gains or dividend income, which are taxed at preferential rates. Taxable amounts are calculated based on the individual's income tax bracket.